Donald Trump is telling you exactly what stocks to buy and what areas on the market to focus on. Surprise, surprise. We have been covering these for time over time, and we're going to give you our insights into if you should buy or if you should sell these stocks. And even more importantly, we got a new Fed chair coming in, and we're going to show you what happens whenever a new Fed chair comes in. And the most important high-level subject that we're going to get to at the start of the video is the yen carry trade and how is that going to affect equities, bonds, and mainly your portfolio that could lead to huge, huge drawdowns in the market if you're not prepared for it, like nothing that you've ever seen before. Let's get right into it, right? So the yen carry trade is basically super, super, super important because it's a huge, huge strat that our hedge funds do. So Japan, right? What do they have going on? They had unemployment problems. So whenever you have very little high unemployment and you have very low inflation, you can have your rates at 0%. So they had 0% in low interest rates for years. And that meant that their yields, right, on their bonds would be super, super low. So that our US hedge funds had this genius idea, right, to go borrow yen, turn it back into dollars, and then invest it in the US stock market or making equity prices and gross stocks go up, or invest it in our bonds, which whenever you buy a bond, price goes up, yields go down, and it makes it more affordable for the government to pay debt. And then they would also get 4% just risk-free rate of return on their investments extra, and they would be hedged up and levered to do this. This works until the US Japan yen yields gets too high, where the Japanese currency is super, super low in value to the dollar, and they're like, oh, all that stuff is getting pushed onto us. We need to buy back yen and make it more of a formidable ratio for them. And whenever they buy back yen, this means that their currency goes up in price. They also could raise rates, or if inflation goes up in Japan, then their yields are going to start going up eventually, and that's going to attract capital there, right? Because whenever you have capital flow in, the yen, without even the Bank of Japan buying it back, is going to go up in price compared to the US dollar. What does that do for the hedge funds? Well, the hedge funds are borrowing back, and they have to get it back into dollars. If dollars are a lot less weaker than whenever they borrowed, they're going to take a huge loss on those positions. Also, right, what could happen is you could have the yields go up where you're not getting that crazy spread. So just to show you what happens, like I was illustrating here. So borrow Japanese and US, then you invest in stocks, appreciation because the US rates are higher, their yields are higher. Then you liquidate the stocks and you repay back the original debt with the depreciated yen. And that only works if the yen stays relatively cheaper to the dollar and the Japanese yields do not go up, right? So what happens after this? The US hedge funds, they start selling tech stocks and US bonds. And what is happening in the market right now? Your 10-year is at highs it's been in a long time. It just hit at 4.5 because we're going to get to it later. What's going on today with the Japanese yields and their yen and the USD to JPY ratio. And whenever this happens, bond prices, they're going to go up because less people want bond prices go down because less people want them. Yields go up. The U.S. government and other companies here, now they have to pay higher interest rates on any debt they take. What does that do? Well, first off, the U.S. government has to refinance 1/3 of their debt this year. So if yields are higher, that's going to mean more and more debt in the years down the line, possibly leading to inflation and money printing by the U.S. government. Companies, if they have bad balance sheets or anything, they're not going to be able to pay back those yields or refinance, and they're going to go bankrupt. And other companies just might not be able to get loans, leading to a slowdown in unemployment. So this just right here is the yen carry trade group, right? So say there's a tightening of US, the Fed's dovish, so they're like, okay, let me just go and borrow there, bring money back here. Then the yen starts to appreciate, right? Then you unwind the carry trade, and then the tightening of global financial conditions because there's less liquidity, less borrowing in the markets with that yen. So then yields are going to go up, and whenever yields go up, that attracts people to put their money in them. So they put their money in yields and bonds instead of stocks, and the equity market doesn't go up as much because all that money's tied up and there's less liquidity. So if you can kind of grasp what we're saying right now, US yields up, bad for the US economy. JPY yields up, bad for the US economy also because a lot of the funds are borrowing there and they have to liquidate their positions. Also, if their yields go up, currency is going to flow in there because they're like, okay, let me take advantage of these yields here. And that's going to mean yields across the whole world go up like you're seeing right now. Whenever yields go up, it's harder for companies and governments to service those debt payments, which leads to more inflation or companies' unemployment and companies going out of business and less spending. It just give or take. Sometimes it's one, sometimes it's the other. So that's all you have to understand. And that's why these yields are going up. So now you're asking, how does this even tie into inflation and everything right now? Because I thought that PPI report, CPI report pushed those yields up, which, yeah, it did, because bonds are going to go and say, hey, what do we think the Fed's do next? And what are the inflation expectations? But this huge move that you're really seeing is from the yen carry trade, which is what people are going around. They're like, oh, it's just about inflation. No, you need to know this, and you need to know how it affects, because this has happened before 2 years ago, and we're going to show you similarities of what happened then and the difference right now. So what happened in 2024, right? So that JPY and USD dollar, that ratio, right? It got up too high. So the BOJ intervened and they bought a bunch of yen to appreciate the currency. So the ratio came down. Anytime over 160, it's the red warning. It's dangerous. So basically this to strengthen the yen and curb the volatility. And you might be saying, well, you just told me this is so horrible. What happened to the US yields and their economy and everything? Nothing, because we were doing at 2024? We were starting to cut rates because we were coming out of that 2022 huge high inflation crisis where inflation was coming down. We're like, okay, pals, like we can start to drop rates and business activity can go up. This led to US yields actually coming down, because if inflation's going down, trending down, your long end, your 10-year is going to go down, because that's like the 10-year inflation expectations. And your 2-year, which really tracks the Fed's fund rate, that's going to come down because of these rate cuts. Equities are going to go up because rate cuts, because bonds are yielding less. People say, hey, they're not as attractive. And the discount rate, the formula for CAPM has the risk-free rate. So a lower risk-free rate, a lower discount rate, which goes into whack. And then your intrinsic value of your stocks looks way higher. So people are going to keep buying it, pushing up the market. Now you're asking me, how bad is it right now? It's pretty bad. I can't lie. I can't say anything like sugarcoat it or whatever. It's horrible, because you're having the same thing where that yen, JPY, and the US, that dollar ratio is high. The Japan 10-year, instead of 2024 being just about 1%, so it wasn't attracting that much capital, it's up to 2.7% because they might have to raise rates again, and that inflation's starting to get worse there. And you might ask, why is inflation getting worse everywhere else? Well, there's a big war in Iran where oil is going up high in price, and what's that doing to inflation? It's making it fly. So this war is at the worst time possible for the rest of the world and could lead to a whole financial collapse that we don't even get into private credit or anything that this could lead to right now. So with this going up, you can see the US yields are flying up because money's coming out of that could be going in the US in those bonds, and it's going back to convert into yen, or it's going to chase those Japan yields, right? And on top of this, the yields are going up because CPI comes in the highest since May 2023. And PPI, the producer price index, the producers see it before the consumer see it to them, it's up to 6%. Now, if it could not get into core because it could be oil, it's transitory and just a one-time shock. If it gets into core, and we will have to jack up rates. This could lead to a CPI in the 4s. If you have a 4, think back to 22. How high did that get? What happened in the stock market? What happened to the economy? What happened to inflation? What happened to your purchasing power? With all of this happening at the same time. And bond yields up, no rate cuts because inflation's up, and we could have rate hikes, which are going to make those yields skyrocket higher than you could ever think. The short end and the long end. And that puts Warsh, the new Fed chair coming in a horrible position, because Trump's saying, you got to cut rates, but you physically, with this stuff happening, it's getting harder to cut rates and everything right now. And this is a touching subject that goes so far just past your portfolio, past the equities market. It could affect your job, your family's life, your purchasing power if this actually plays out. This is something you need to keep an eye on, because traditionally, whenever bonds go up, the U.S. government's going to have to crash that market because they don't need to be paying that much on their debt. We have 1/3 of our debt this year. $15 trillion coming up. They're going to have to refinance that at possibly 5% instead of 3.5, 3, because we're in Iran in this war, and oil's coming up and the straits closed. Because yields and everything are pricing in. So they got a very little time to get this down, which means I think the war and that straits has to be open soon because all the countries are feeling it. The yen carry trade unwinding to tank our stock market possibly. So that's something to watch on, because the longer this war goes on, the higher probability of this happening, because you've got inflation smacking you right in the face on this side, And then you got the yen carry trade making bonds explode on the other side right now. You're fighting a two-front war, a two-pronged war, where last time this happened, like we saw, rates were coming down. So the market said, okay, we're good. We're chilling, right? We're going on vacation. This time, if you've ever watched The Wolf of Wall Street, that one scene where the first one, they're like going crazy like that on the cruise ships out there and having time. And then the next one, they're cowering and hiding because there's a huge storm. We're heading right for that storm right now. We're not in that vacation mode or anything. So that's what I just want to show you guys. And it gets even worse for equities possibly, because look at, in the 6 months of the last 6 Fed shares, look at the drawdowns that have happened. 17.1%, 13.3%, 33.5%, 7.7%, 4.2%, and almost 10%. So why does the market do this? Because they want to test Fed shares, say, who's this guy? What's he going to do? Is he for liquidity? Is he for raising or hiring rates? Is he a dove? Is he a hawk? What better time to test someone whenever yields are skyrocketing higher than they've been in forever? Inflation skyrocketing higher. And the market hates not knowing what's going to happen. They don't like that. So what do you think they're going to do? They're going to be more cautious and more hedge and more protection for equities. So you get a market that's flying high. Everyone's like, AI, AI, AI. What could happen next? Just think about that in your head with these valuations. That's something that we've been looking into, the valuations, where like we said, we've been trimming AMD. We've been rotating money into these other stocks, some of them that we're about to show you today, and finding the undervalued areas of the economy that have basically been in recession for the last 6 months, that are down 20, 30%, 40%, 50% even some stocks, even 80% some stocks. So just understand that. So just take all this information, because this is just such an important subject, and it's a high level that people don't really understand, because they're going to come out and say, oh, hey, this is inflation, this. No, there's 2 other things at work, and you got to think how all the dots connect and how do they work. That's how you become a better investor. That's how you play this game, and that's how you're ahead of other people. So now we're to the fun part, right? Trump's past investments. Well, let's just go back to last year, April. What in the world did he do on the bottom of the crash? The very bottom, Trump tweeted out, buy on social media, takes off a bunch of tariffs, tones them down, and then the market has a huge V-shaped recovery, which if you're in that, you made life-changing money. If you're in specific stocks, you probably made 100%, 200% just out of that crash in the next year. Especially like you could have been buying AMD at $80 then. It's 400 something, 430, 440, 450 right now, right? So just Trump, whenever he says something, maybe you should listen, because love him or hate him, he is the president. He does know what's going on in the policy. Look at all our Congress. They make everything there. Nancy Pelosi, Dan Crenshaw, all of them are making so much money both sides of the aisle. So put away your bias for a second, and sometimes whenever someone important says something, maybe listen. And we even got someone else who took another position in the sector that's a pretty great investor that we're going to show you later. The next investment he made was Intel, whenever the stock was about $20. This stock's over $100 right now. Maybe this dude has some ideas. Maybe he's been talking to Jensen. Maybe he's been talking to people saying, this is going to be the next phase of the AI movement. This is going to be the next phase. This is an undervalued area. Maybe you should think about what he's saying and look at these stocks in the sector that he released out, because this is free. He has to report it. What has he been buying? Just look at these. ServiceNow, Adobe, Oracle, Microsoft. What is that sector? What is it? SaaS, software as a service companies that we've been telling you are just crazy undervalued. The IGV, no one wants to even touch it anymore. Like we said, the market, half of the market's been in a big recession. These stocks are sold down to just such insane levels because people are they don't know what they're doing. Simple as that, right? So just concentrate, just go through all of his investments, say, what sector is he targeting? Because maybe that's the sector that's going to pop next, and maybe it's a sector that people are doubting on for no reason whenever they keep putting up great numbers, which we're going to show you. And maybe the semiconductor, that 100% run since November, while they're down 22% in the SaaS sector in the IGV, maybe it's time to start rotating money there, because if we have a big recession, what's going to get hit the hardest? The one that just ran a bunch, with the one that's the growth stocks, the one that all the money's going in, the momentum traders, they're going to pull that money out, and you're going to see semis, if we have a recession or a pullback, they're going to get hit the hardest in the market, and the sector rotation is going to happen, where money's going to go to the SaaS. There's been a consumer discretionary, like Celsius and all these companies are going to fluster, and they're going to be great returns over the next few years because just the trading at crazy low 4P and valuation ratios right now. So that's what you got to think. You don't want to be chasing, oh, the semis have ran this much, they're going to keep going. Maybe, whoa, slow down there. Maybe take a breather, evaluate, say, if everyone's talking about semis, there's got to be some great deals in other portions of the markets. Just think about that for a second. If everyone's talking about something, there's something they're missing, because eventually that no one was talking about semis, and now everyone's talking about semis. They're getting in at the final hurrah. So that's what you got to think. The first stock that Trump bought, we want to talk about, ServiceNow. What in the world do they do, right? So they go and they kind of connect your whole company together. So you can connect your IT department to your finance department, to your mechanics department. So if something needs fixing technology, you can just notify the IT department, and they're super scaled up, and they've been in these companies for years. They're used to using them. So say you switch off ServiceNow. Say some agentic AI model comes and takes the whole company. One, you have to retrain all the employees. Two, you lose 20 years of data possibly for your company that you have to rebuild that they have with all your operations. And three, it would probably take you a year just to go and reintegrate everything and everyone. So that's why these are so hard, and that's why their revenue is so hard to switch off of. And their CEO and Jensen are out there saying they're bullish. He says $101 trillion market cap. That's over a 10x by 2030. And if you look at this, look at their revenue going up over these last years, flying higher. Look at what we're going to show you what they're trading on at their price to sales ratio. That's crazy. And their net income rate has been going up since here. Now, what are they doing right now? They're spending extra on for the next few years because they're spending on AI models. They're going to help you. They're training AI models to basically help their company, AI agents, to help these people and deploy them that may actually make them more efficient and make them more profitable in the future, is what these companies are doing. And while everyone's selling them, sell from $100 to something dollars down to 80, 90 where they are right now, that's whenever you want to be buying, whenever everyone hates them, whenever the sentiment's horrible. And just look at this earnings history. They beat almost every single time, which this was probably just a one-off they missed there. They're almost perfect. They're almost always beating. So that means a good CEO, he's reporting good. And their price to sales ratio is just dropping down, even though they're growing revenue at a great clip over the last few years, just up and to the right. So just to show you our projections that we have for ServiceNow, our base case, we just have them doing about 18% revenue growth a year. Net income growth, 20%, not even expanding their margins crazy. Buying back a few shares a year. Trading at just a PEG ratio, 4 PEG of 1, where they used to trade at 2. So we're not even saying anything crazy or valuation-wise. And you're getting a 28% compound annual growth rate for this stock. And the best part is their bear case, you're getting 15%. You're outperforming the market. Say instead of 18, they go revenue at 13%, way less than they're projected. 15% net income margin. And they share buyback dilution is 2% a year. They trade only at a P of like 25. You're still getting 15% a year with this stock. And that's what you look for. Good base case, very high bullish case, which we're going to show you. And bear case is better than the market, where I'm not even worried. It's going to do great, okay? And the revenue growth, 21%, 23, barely even expanding those margins. Better buybacks, and you're getting up to a 40% compounding annual growth rate. Trump just bought it. And other big investors are buying these SaaS stocks because they see fundamentally undervalued opportunities right now. So that's what I just want you guys to think of there. And the next ones we're going to go into, right? Adobe. This stock has been beaten down over 50% over the last year. Think of how much you still use Adobe. I use Adobe to even make thumbnail and everything for this video. Go edit your photos. And so many people have accounts and all these creations with them, where if you want to go just use an AI model, go ask Chat, go ask Claude, go ask anything to make you something. It looks like crap. It looks like the most AI, most comical, everything. It doesn't look good. If you want something to look good, you use Adobe. If you're a professional, use Adobe. I know some people are like, oh, AI looks great. It can't even tell you where to put a bathroom in a house. You ask AI, hey, I'm a minute away from the car wash. What should I do? Should I drive or should I walk? It goes, well, you're only a minute away. You should walk to the car wash. Well, where's your car? It's still stuck back at home. That's the thing. AI is not on these levels, and these are all spending, right, to basically make themselves AI proof and work with AI. Jensen said, like, if you remake an AGI cyborg robot, right, are you going to reinvent the screwdriver, or are you just going to reuse the screwdriver? You're going to reuse a screwdriver if you're a smart person. And a lot of people running these companies are smart people. So that's why they're going to keep using these models. And they're actually going to be a huge beneficiary of AI while everyone thinks they're going to get wiped out. Look at this. Revenue, net income, up and to the right. Best part here. Look how many shares they're buying back. Over 400. They're buying back like crazy. That's what you want to see. They have so much extra free cash flow they can buy back. And what does buybacks do on the bottom line? Makes their EPS look so unbelievably good. So let's go and just look at our predictions for Adobe right here, right? So Adobe, with our base case, 9% a year. They only have to grow at 9%. Just 9%, right? They grew revenue in their trailing 12 month at 11% a year. Okay, so they're already going down, decelerating. Net income only growing at 10%. And this is with them not even buying back crazy amounts of stock. What if they went and they started buying back? What if they just bought 3% a year, right? Look at this. Look at what happens. If they buy 3% a year, with 3% is not crazy for them. These companies have so much cash flow, they're getting rid of everything. Are you serious? They could be doing 3% buybacks a year. It's in the say here. Let's put okay. Say they have even more free cash flow, more everything. Let's just go buy back more of these stocks, right? Now you're looking at a base case of 20% because they're trading at such a crazy low share price. Trading only a P ratio of 15. Only a 15. Well, they're growing net income at 10. They're growing higher than the market. They don't need to outperform. They just need to have a PE under the market while they're growing probably better than the market is. That's all they have to do. The SaaS just has to get money in, and you're getting 21% a year from Adobe. Why do you think Trump's buying this stock? This base bear case, 7.58%. You're barely getting any leverage. Buying back that, you're getting over better than the market just from your base case average. Trading at a 12 trailing 12 P. Like what? In your bull case, you're getting a 33% gainer, just 10%, 12.5%. Only getting up to a 20p, trading probably right around where the market's trading at, going way higher than them. Even if Wall Street's like, I still don't like this stock, trading at a 4 peg of less than 1, you're getting a 33% gain over the next 2 years. So just think about these numbers, and that's why the importance is running the numbers and not listening to the sentiment and not listening to whatever other people. Because you can find great opportunities, that needle in the haystack, that no one else will take the chance to look at. The next stock we want to tell you is Salesforce, customer relations management shit, right? So basically they have Agent Force coming out, and it basically goes, and it's an AI model that can help talk to the customers and help them figure out what they want to do. So they're already using AI, and it's helped them, and they're getting so many more people on it, and so many more people use cases using them. So they're benefiting from AI. Like I've said, these companies are going to be doing. Look at their revenue up and to the right. Shares outstanding down on a diagonal thing. So they're buying back shares because they're making back so much money. And just wait till you see how many shares they're going to buy back. Benioff is a great CEO there, and he's going to steer the company in a good direction. He's been there for a long time, so he's had to go through so many different events and stuff happening in the market that they just know. And look at what this company does. Over this last, they beat like EPS by 95% of the time. Revenue, 78% of the time they beat. Average EPS beat 8.21%. So just look at them, how they beat, how they perform, how he's been there. He's been there for a while, that you can just trust in them. Which, like, if you want to knock Adobe and say, well, hey, their CEO left. You know what? I agree with that. If you can't believe in their CEO, don't trust where he's going to take the business in a time like this, that's valid if you don't want to invest in there. Personally, just me running the numbers, even if he does just whatever he needs to do with their old CEO staying on the board, he's going to have it great. Salesforce, you get the same CEO there. They buy back 13% of their shares this year. They have a huge buyback program. Revenue growth at 11%. Net income growth at 25 to 13%, where they're buying back shares. And just because their margins and everything are better and people see them as more of a sticky business model, that's why they're trading at a higher P than Adobe. Because, like, right, the company relation management, you've been using for a long time, so how are you going to replace them? Trading at a 23 P ratio. You get a 23% over the next 2 years as your base case from these prices. They're only trading at $174 a share. Your bear case, you only grow 8 to 10, trade at 17, 11.5%. In your bull case, you're getting almost a 40%. So I just want to ask you, these last 3 SaaS stocks I showed you, what are the big common things you've seen from the valuation? Bear case over the market average, base case over 20%, and a bull case close to 40% with not even crazy valuation ratios, which if they reaccelerate like that, oh wow, they're going high. They're going higher than we even think, okay? But we want to just stay calm in our cases, nothing too crazy, nothing too egregious. And that's the sector that's undervalued, and that's where you got to be looking, because no one wants to buy SaaS stocks. If you can own these and find these companies in a recessionary type of their market for their sector, well, everyone's buying semis. The money's going to rotate back in, and those same people were buying semis at crazy high valuation levels. they're going to be buying SaaS at crazy high valuation levels in the future. That's just how it works. That's how you make, and that's how you do better than other people in this market. So I told you, big investor, Bill Ackman, one of the best. He gets over 25% a year after fees for these clients and their funds. So this guy knows what he's doing, right? Warren Buffett gets 20% on his average over his time. This guy gets 25% because you know what he does? Long-term holds, finds undervalued opportunities whenever no one else wants them. They build a position in Microsoft. Trump bought it. SaaS again. What I've been saying, SaaS. These are going to have the run. People are getting their prices down low. So basically, he said the software giants created a crazy rare opportunity to buy one of the most dominant technology franchises at a crazy valuation. And they're trading only at a 21 times 4P they got in there. And it's trading at such a discount over the last few years that it's a core holding. And if you know anything about him, he has like 3 or 4 holdings that'd be like 60, 70% of his portfolio. They're down 26% and he just doesn't believe in this. So this is just out there. Other investors saying, hey, the SaaS companies are just getting traded at a crazy thing. You've seen the IGV trading down, that this is a great area to be putting in sector into your money. So that's what basically these coming in and saying. The last company we have is SoFi. Trump was talking about them. Hey, Minoto, getting tighter with the Trump accounts and everything. And what's the big deal with that? Well, look at what their revenue's done. Look at that net income going up whenever they return profitable. And just think, well, they're trading at $32 a share price around start of this year, last November. What are they trading at right now? Just think in your head, like, hey, what's going on? I know analysts are lowering the prices on them, right? Maybe they just missed earnings or something, right? No, they beat earnings by crazy amounts. They haven't missed at all. They beat everything, even though they've had whatever disruptions. And everyone said, and their guiding were projections with their guidance. So they've not had problems. Anthony Noto's executing perfectly, and they're asset light. So if anything happens in the loaning, they're pretty good prepared. And they basically have this financial services loop where you go on there to pay off some money. Well, you can go invest, you can do student loans, you can get a credit card. So it keeps you on there using multiple use cases. So the company doesn't have to go spend money on marketing to get you to say, hey, come use us. Well, because you're already on there for another, say you want to just go get a loan, now you might use a checking account. And the craziest thing is, analysts have been taking their price targets down while institutional ownership's going up. What does that tell you about the stock? They're trying to get out the weak hands of retail and make them sell at low prices so they can even lower prices. And then they can fly up this stock. But just to show you this, let's just show you our numbers that for what we have on SoFi, right? Base case, they're growing revenue at 32%. They're projecting 30%, but they always beat. Like we showed you, they sandbag. Net income growth just a little bit better at 42%. They always beat. They sandbag. Just this year, they should go to $36 a share price. This is with them trading at a forward peg of less than 1. Less than their overall industry. And they grow at this, and they get to a $101 stock with a 60% compound annual growth rate by 2029. Their bear case, you're still getting almost 20%, which is going down to 20% revenue growth, 25% net income growth. Dilution, trading at a P forward peg of like just around 1, trading less than the banking industry. And you still get the $30 a share price from 16, and you're getting a compounding growth rate of almost 18%, beating the market. We love that, right? That's great. We want to see that. Bull case, just wait till you see these numbers. They're insane. 36 and 50, no dilution. Just trading a forward peg of less than 1, this much less than 1. They're getting to $154, almost an 80% compounding growth rate. You're almost doubling the stock every single year for the next 4 years. Just think about that in your head, the opportunities that they have, where they said they're going to get to 50 million members, the CEO they have in Anthony Noto, and where they're taking the business. Thank you guys for watching, and just right here we've had it. We use a site to make our projections. It's fortgamma.com. There's a free beta out, no card. All you do is go sign up, make an account, and you can make your investing journey go to another level. We're going to have this charts features coming on soon, and it's help you make your research process more efficient, and then you can go do your projections, test all of them, organize your portfolio, and everything is coming to the site, and have access to institutional grade information to guide your investing journey to get these huge returns, get these 80% compounding annual growth rates, beat the market, retire, live a great life, go on all your vacations using this software. And if you ever want to see stocks, like we've had it, people in the comments say, hey, can you look at this stock? We're going to get to them this weekend. Go and say in the comments, say, hey, can you investigate this stock's reported earnings? What happened here? What am I missing? Why did it go down? Why did it go up? Because 99% of the time, it's just a great buying opportunity just because something happened in the business and people don't understand it. Wall Street wants a lower price. They're missing it like they did with AMD in front of their faces. So just keep asking questions and just like and subscribe if you want to see more of this content.